In this week, Simplified, we're going to simplify the chart of accounts. So we're going to go through and we're going to use the chart of accounts because for me, the chart of accounts is your foundation of bookkeeping / accounting. We start off with numbering the accounts because that makes it a little bit easier for me to be able to, identify the accounts. And at the same time, when I'm in QuickBooks, I can get in there and I can actually sort them by account number instead of alphabetical or by type. But I typically like to have it under account. That way, at least I know that everything is going to flow the way I need it to flow. As you can see here, I've got the 1,000 accounts, and I've got the 1,000 accounts all the way down to the 1,500s. But all of these are all of your what's called assets. So you'll see the checking account, you'll see the accounts receivable, your inventory, your assets, right? And then your accumulated depreciation and amortization. Then from there, we jump into the 2,000s. The 2,000 accounts are your short-term and long-term liabilities. So these are all included in here. So you got your accounts payable, if you're doing bills and stuff like that. Then you have your credit card. If you're using a credit card specifically for the business, then you can track that credit card here with all the expenses. And then you have your payroll liabilities. But as you can see here in this payroll liability section, you see how I have the semicolon here? That means that it is a sub-account of this payroll liability account. So that's why I label these 2100.10, so I can see that it's a payroll liability, but I want it to be underneath so I can see these 3 items separately. Then after that, I have sales tax, and then I have my sales tax accounts, and then I have my short-term liabilities, and then my long-term liabilities, which could be a bank note or could be a loan payment to a car. Then the 3,000s is your equity account. And this is really where, I like to have the owner's contribution and owner's distribution accounts in there so that I can see what money the owner is taking out and what money the owner is putting in. The opening balance equity account is primarily used for a throw account. It's kind of like one of those accounts where if you weren't tracking something in the past and now you want to start tracking it, but we don't want to be messing with the previous year's profit and loss statement, things like that, we'll throw it into this opening balance equity and then adjust for it. Then after that, we start with the 4,000s. So the 4,000 accounts are going to be all your income accounts. Your 5,000 accounts are going to be all your cost of goods account. And then the meat and potatoes of this whole thing is in the 6,000s because this is where you have all your advertising, automobile expense. And again, as we went over in the previous section there, the automobile expense, you see how it has the colon there. So that auto expense, auto gas is in there and it's sub-accounts of the auto expense. And well, it's like, why do you have all that detail? Well, I have that detail because when I'm doing the income tax return, I like to be able to separate these out because when it asks you for the automobile expenses, it'll ask you how much did you have in insurance, gas, repairs and maintenance, things like that. So it makes it easier for me to plug it into the income tax return. Then we go into bad debt, we have bank service fees, commissions, computer and internet expenses, contract labor, donations, dues and subscriptions, insurance. You can see here, insurance has that colon, so insurance business expenses is a sub-account, so you can have as many as you want there too. Interest, meals. I like to have meals and entertainment. Meals separately because entertainment is not deductible. So then meals here with clients. And the reason why I separate out meals with clients and team meals is because with meals with clients, those are 50% deductible and team meals are 100% deductible. And so by separating those out, I can then fit that into the income tax return. Merchant service fees, payroll expenses. You'll see here also I like to have sub-accounts for salaries, Social Security, FUTA and CUTA. All of these are company portions, which is the company has to match whatever's being deducted or being taxed for Social Security, Medicare, FUTA and CUTA. Then you have your legal expenses, and then you have your rents, repairs, taxes, travel, utilities, and then you jump up to the 7,000s, which is your other income, and then you have your other expenses way at the bottom, and then you have the 9,050, which this account is primarily put in there by QuickBooks so that when you doing a bank reconciliation, if you can't tie it in, then you can just go in there and you can say, well, just make the adjustment, it'll throw it into this account. And then we have the all-encompassing Ask My Accountant, which works both ways. If we're doing the bookkeeping for you guys, we'll put stuff in there and Ask My Accountant, but it's really more Ask the Client. But at the same time, if the client is inputting all of their expenses, then if he doesn't know where to throw it into, what category to throw it into, then he'll throw it into this Ask My Accountant, and then we'll go over it with them on this. The second part of this video in Chart of Accounts Simplified, it's the same thing as we were discussing before, but now I put it in a little different format. So the first item that we're talking about is a standard chart of accounts, and then we have the balance sheet here. So under the balance sheet, then we have the 1,000s, right, which are going to be your assets. And then you have your 2,000, which are going to be your liabilities. And then you have your 3,000, which is going to be your equity account. So it's a little bit different, but it kind of sees it from a different perspective. The same thing. Your 1,000s are going to be your assets, and they're going to be the bank, accounts receivable, current assets, fixed assets, accumulated depreciation, and accumulated amortization. Your 2,000 accounts are going to be your liability accounts, right? So now your accounts payable, your credit cards, your short-term liabilities, long-term liabilities, and then your 3,000 is going to have your equity, which is going to have opening balance equity, retained earnings, owner's contribution, owner's distribution. Then on the second side of it, this up just a little bit here. And let me move this over. Now we can see the profit and loss. So now the profit and loss has the 4,000s, and the 4,000s are your sales. Your 5,000s are your cost of goods, and then your 6,000 is your advertising automobile, which is almost the same template that we had in the previous one, but just again, we're seeing it in a different perspective. Then your 7,000s are going to be your other income. And I have a little footnote here because this is cost outside of your regular operating expenses, which again, if on the other income here, you would probably have something like interest income, because that's not part of what you sell or anything. And so then that would fall under that. And then other expenses would be like, maybe you're going to sell a piece of equipment or something like that. So you would have that, that expense there, right? Your 8,000, then your 9,000 is going to be your, let me get this over real quick here. Your 9,000s would be all of the other miscellaneous expenses. So that pretty much concludes the Simplified. Thanks for tuning in to Simplified, Chart of Accounts. If you found this video helpful, make sure to hit the like button, subscribe, and turn on notifications so you never miss out.